The blueprint for a perfect credit score, simple steps that actually work. 1. Credit score basics. Credit scores run from 300 to 850. Under 580 is bad. Between 580 and 669 is fair. From 670 to 799 is good. Anything above 800 is excellent. So what does that actually mean? It means the higher you go, the more perks you get, lower rates, easier approvals, and fewer headaches. People in the top tier are called super prime. Life is smoother there. If you're subprime, it's the opposite. You'll feel like you coughed in public during the pandemic. Footnote. Credit scores are simple labels that lenders use to quickly judge risk. 2. Why lenders care. Your score tells lenders how likely you are to pay them back. Super prime borrowers usually get approved, 84% of the time. Subprime borrowers? Only 19%. Renting an apartment, buying a car, or even dating, yes, even there, a low score makes life harder. Try putting credit score 380 in your Tinder profile and see what happens. Spoiler, rejection. Society equates good credit with trustworthiness, whether that's fair or not. Footnote. Lenders use your score as shorthand for your reputation. 3. The 5 factors. Credit scores are built from 5 pieces. Payment history is 35%. Utilization, the percentage of credit you're using, is 30%. Length of history counts for 15%. Credit mix is 10%. New credit is 10%. So what does that actually mean? It means 2 habits: paying on time and keeping balances low, control almost 2/3 of your score. The rest helps but is less powerful. Footnote. 2 main habits, on-time payments and low balances, do the heavy lifting for your score. 4. Payment history. Pay on time. Every time. That's it. Miss a payment and it sticks for 7 years. But don't panic, a single slip won't end you. Just don't make it a habit. If you hit 98 to 100% on time, you're golden. Less than 90%? Not so good. Lenders want to see proof you keep promises. So what does that actually mean? Pay the bill before Netflix reminds you again. Footnote. Consistency matters more than perfection. Most lenders forgive an occasional blip if the overall record is solid. 5. Credit utilization. This is how much of your available credit you're using. Lower is better. Under 10% is excellent. Over 60% is rough. Imagine 2 friends asking you for money. One already maxed out 95% of his cards. The other only used 55%. Which one feels safer to lend to? Exactly. Tip: pay your cards multiple times a month so the bureaus see lower balances. And don't close old cards, the extra limit helps your ratio. Footnote. Credit utilization is the quickest lever you can pull to improve your score. 6. Credit history length. Longer is stronger. Accounts older than 25 years look excellent. Newer accounts lower your average. So don't shut down old cards even if you don't use them much. Age works in your favor, so the earlier you start, the easier it gets. Footnote. Credit age rewards patience. Keeping accounts open is often smarter than closing them. 7. Credit mix. Having different types of accounts, credit cards, auto loans, mortgages, helps a little. But don't force it. It's only 10% of your score. No need to grab a random loan just to diversify. Focus instead on the bigger factors. Footnote. Credit mix is a bonus, not a requirement. Don't chase it. 8. New credit and inquiries. Hard inquiries, like applying for a card or loan, ding your score for up to 2 years. Soft pulls, like checking your own credit, don't matter. Multiple hard pulls in 2 weeks count as one, so shop smart. If you just got a car or mortgage, that's the perfect time to grab a new card, because no one will be checking for a while. So what does that actually mean? Plan your credit moves the way you'd plan a vacation, bundle them close together. Footnote: hard pulls matter less if they're grouped together, timing saves points. 9. Watch your reports. Errors and fraud can crush your score. Check your reports regularly, through bureaus or your credit card app. Dispute mistakes fast. Sometimes a correction can jump your score by 100 points. That's real progress, not theory. Footnote: monitoring your reports is free insurance against fraud and mistakes.